Hi, welcome back to Arizona Lifestyles with me, your host, Holly Waxman, and three special guests I have here today. Sarah Perkins with Navy Title. Welcome, Sarah.
Thank you so much for having me.
Of course. And Adam Dahlberg, my favorite.
Hello again.
Partner.
Good to see you.
Good to see you. And Ryan Nelson, one of the best lenders and men that I know. Ryan Nelson, welcome.
Thank you.
Thank you. Well, today we have a really exciting show. We're going to talk, if you're a first-time home buyer or thinking about buying your home, we're going to talk about some great tips so that you can get the lowest interest rate out there and have a really successful sale. Ryan's got some special information to give us on how to get little costs for your home and how much you need to put down on your home. So to start off with some home buying tips, Ryan, can you tell us about the 5 types of loan programs that people have availability to use?
Well, there's really the big 3, okay, that most people do financing. Really, it's the big 2, okay? You've got conventional and FHA, and that's what most people default to one of those 2 types of loans. You know, there's pros and cons to both. You've got veterans for VA. VA, if you're VA eligible and you're able to do a VA loan, hands down, the VA wants to take care of their veterans, people that have served. It's a great loan, and a lot of advantages to go into VA. But you got to be a veteran to have eligibility and be able to take advantage of doing a VA loan.
So Ryan, if you do a VA loan, what would that look like? How much do you have to put down? What does that look like?
So we'll touch base on the different terms and, all the different, but the other 2 loan types, you've got non-QM type loans, stands for non-qualified mortgage, meaning you're using alternative types of documentation to document that you're able to afford the mortgage. You'll hear DSCR as a term. It stands for debt service coverage ratio loans. A lot of investors will do those types of loan products. There's asset depletion type loans, where if you have a lot of assets, you're using those to be able to afford and qualify. There's bank statement loans for people that are self-employed that write off a lot of income on their taxes, and by using traditional methods, typically wouldn't qualify, where you can use your bank deposits to document the stability of your business and your income. And then there's USDA, which if you're buying in an outlying rural area, USDA is a great loan as well. So let's touch base, on the down payment requirements of each type of loan. And we'll start with veterans. Okay, VA, hands down, best way to go if you're a veteran. There's no down payment. There's no mortgage insurance, and the interest rates are going to be better than conventional doing a VA loan. It's a great way to go. So if you're a veteran, you have a really awesome opportunity to take advantage of your service-related time and be able to qualify for home ownership by doing a VA loan. FHA requires the same down payment for everybody. It's 3.5%. You can put down more money and get a little bit better terms in regards to your mortgage insurance if you're putting down more than 10%. A lot of people do FHA because the credit requirements are not as strict as conventional, and it allows for lower credit scores. A lot of people refer to FHA as a first-time home buyer mortgage. You don't have to be a first-time home buyer. You can have owned a home before and do an FHA loan, but because the credit standards are a lot more lax and easier, and they allow higher ratios than conventional loans, FHA is a great way to go. Conventional is good, and what a lot of people do, if you have a large down payment or even little money, they allow you to get in as a first-time home buyer with as little as 3% down. And your mortgage insurance that you pay, if you put down less than 20%, it's risk-based. It's based upon different criteria. Your credit score is going to heavily dictate how much that mortgage insurance is. But there's a lot of great programs for conventional and people putting down 3%. There's even programs that go in conjunction for first-time home buyers or people that don't have a lot of money to be able to qualify with less than the regular down payment standards by getting grants or different type of bond loans. The industry term for those is down payment assistance type products. There's a lot of those available for people. So you don't need a lot of money to get into a home. And there are programs that can help you get into a home with grants that are forgivable, where you literally can get in with no money out of pocket. And you can do those in conjunction with a conventional or an FHA loan. So lots of opportunities to get into a home. And the myth that you have to have 20% down, the myth that you have to have great credit, absolutely not true. There is tons of opportunity to buy a home, become a homeowner. You know, the price of rent is almost as much as getting into a home these days. So it's better to pay your own mortgage than pay someone else's every time.
And to add to what you were just saying, Ryan, the national average down payment across all loan types is 8%. So absolutely, that myth of the 20% down is a big thing, and it holds people back. And so sharing that is a really important thing.
And I've personally had some buyers who even bought a home for less money than it would come to rent a home. Because when you rent a home, you need your first month, your last month, your cleaning deposit, security deposit, and
deposit.
Right. And often with putting 3% down on a home, that comes to about the same. And then we all know how they appreciate here in Arizona. How does that work, Sarah?
We've appreciated 60% in the last 4 years.
Wow.
That's a giant number. That's, I mean, just anybody, if you owned a house, you just made a ton of money just because you got to live there. I mean, it's a big deal.
Right. Do you know?
It is a big deal. And the thing that a lot of people that are renting don't think about until after they've rented for a while, when you rent, it's pretty rare to see your rent go down.
It doesn't go down.
When your lease is up after that 12-month period or 6 months or 18 months or whatever that time frame is, most likely because your landlord and because of the market, increasing costs are increasing, taxes may increase a little bit, homeowners insurance has increased quite a bit over the last couple of years due to inflation, your rent's going to go up. If you own the home, I would say 99% of loans that we do for people are fixed rate mortgages. Your payment doesn't go up. Your payment stays the same on that mortgage, on what you're paying for your principal and interest. And you only can benefit yourself by, the market's trending lower. If they go lower, you can refinance that loan and get a lower interest rate. But if you're renting, you're most likely never going to be paying less. In the future, you're going to be paying a higher rate for your rent. People don't think about that until all of a sudden you get a call and they want to try to buy a home and they're frustrated because they just got informed by their landlord that their rent's going up $200 a month, $300 a month. I had one that was going up $700 a month recently. The landlord had rented to them at a market rate that was super, super attractive. And it was just time that, hey, the market bears this amount for renting this property. And if you want to continue to live here, you're going to be paying $700 a month more than what you previously were. And that's what prompted this home buyer to finally say, how can I get into a home? What do I need to do so that I can buy versus the uncertainty? And the other thing with renting too, a landlord situation changes and they may come to a point where they want to sell that property and no longer rent to you. Just because you signed a year lease doesn't mean, and you want to stay in that home, doesn't mean that they're obligated after that year to continue to rent that home to you. And it's very inconvenient when you have to pack up and go somewhere else because moving is not fun.
Right. And so owning a home, even for your own personal security, reliability, predictability, you have so much more chance of achieving that, which also adds to good health and happiness by owning a home.
There was even a thing in the Wall Street Journal this morning that was talking about the vast majority of Americans' wealth is in homeownership. And we've been talking about it it's my soapbox that I love to stand on is the number one wealth creator in this country is homeownership. I mean, it is how people make money and build wealth and build generational wealth, and renting doesn't do that.
Yep. Yeah, it's the number one biggest millionaire maker. Number two, owning a chain of McDonald's, right? And McDonald's claim they've made more millionaires than anybody except real estate. And I'll be honest with you too, what those programs Ryan was discussing a moment ago, for people that are just new or thinking about buying their first home, one of the biggest misperceptions that I see out there amongst buyers is that the loan programs that Ryan was talking about, having a certain amount down, having money, down payment assistance, programs to help you purchase a home. You have your mortgage payment, but then you also need money for the transaction of buying the home, right? You have closing fees, you have money up front that you need for inspections, appraisal costs, all of these things that it's two separate types of transactions. But what's nice is that if you work with a realtor, and this is the important thing of having a good real estate professional on your side as part of your buying team, is because they can navigate those waters and get you into programs or help negotiate on your behalf to lower those costs as well, and to make sure that you're protected. So in addition to things like, for example, having the bond programs and the down payment assistance programs that can get you a lower, into a home at a lower cost, a real seasoned realtor can also probably negotiate fees that help cover those closing costs, whether it's, a couple of percent back to you, maybe even things that could help get you into the home for no money out of pocket. If the seller in that particular situation is, wanting to go and they're motivated, we help navigate them maybe covering all of your closing fees and even your realtor fees and all of that type of stuff. So there are situations when you have an expert team working with these buyers, for example, Ryan or Holly, myself, and then, people that are entitled that are really good at, explaining how this whole system works, that are getting into homes with like 1%, 1.5%, sometimes even lower than that. Ryan, what's the lowest that you've seen somebody in this situation with a motivated seller, a strong buyer's agent, down payment assistance program through one of your lending programs? Have you seen like zero money out of pocket home purchases?
It's pretty rare where it's zero out of pocket. Usually, even with down payment assistance, the buyer typically brings in a little bit of money. But to answer your question, it is possible. And I have done loans for clients where the seller was paying enough of the closing costs as a concession. You had down payment assistance, so it's not a VA loan. And the buyer got back every dime of their earnest money at closing. Wow. So it doesn't happen very often. And in the cases where it doesn't happen very often, even negotiating a standard 3 to 3.5% in seller concessions in conjunction with down payment assistance, the buyer is typically going to bring in a couple $1,000s tops. So it's not expensive to get into a home, especially compared to your alternatives. Your alternatives, if you're not going to buy a home and you need to move and you need to rent somewhere, you're going to be typically shelling out your security deposit, first and last month's rent. That typically totals $5,000 plus from, for most homes, $4,000 to $5,000. So there are a ton of options, and it doesn't have to be, you don't have to have a lot of money to get into a home. You need to know what's possible based upon your situation and have someone guide you through the process so that they can share all the different programs that are out there and what's available for you.
Ryan, are there any programs if somebody wants to put a pool on or fix up the house?
There are different renovation programs. Conventional and FHA have a home style program that's associated with conventional. FHA has a 203K program where it's a quasi-type construction project loan where you can buy the home, have a pool of money set aside to use those funds to renovate the home after you buy it. So it's all rolled into one mortgage in the very beginning. That really yields two advantages to the buyer. Number one, you're not buying the home and having to have a bunch of money to do the renovation yourself. Or number two, you're not buying the home and then having to go take out additional loans and incur additional debt at higher interest rates to go and finish those touches that you want on the home and do those renovations.
Right, and absolutely. Whether someone's buying a home for $150,000 or $5 million, I mean, there's always something people need to do to add to put their own personality and make it fit for their own comfort. So that's really good to know.
Yeah, Yeah, absolutely.
Hey, I want to ask Ryan a quick question. When you are working with borrowers and they reach out to you and they say, okay, this is my circumstance or this is my situation in which, and then budget and all the things, is that when you have, just considering all the things that you rattled off just off the top of your head, right? Like, do you sit down and kind of go through, like, given your situation, this is what I think is best for you? It's so much of a very personalized consultation that you can bring in and say, let's utilize these different programs to get you the biggest benefit. Is that kind of the easiest way for you to talk to borrowers?
Absolutely, 100%. I mean, you need, if you want to qualify, if you want to qualify for a home, it's a really easy process. And it takes 10 to 15 minutes. And the things that are looked at are your income and your assets and your credit. That's it. What does your income look like? And does it show that you have stable income based upon where you work? Do you have a history of that income or a job stability? You have to be able to document employment and income, typically 2 years, and show what that looks like for every particular person. And then based upon their credit, there's certain minimum credit standards on every loan type, and they vary depending upon the type of loan that you're doing. There's a minimum standard that you have to have a minimum credit score. And then the higher your credit score, typically the better interest rate that you get on that particular loan product. And based upon what's on your credit, really the two things that we look at is what is your score and what items and debts show on your credit and how much are those monthly obligations. And so you compare the income with the monthly debts and what the new proposed housing payment's going to be to determine what someone qualifies for. And then you look at the assets. Okay, it's going to take this, based upon your situation, this is how much money you're needing to have to be able to close on a mortgage. Anyone who buys a home, the conversation that I talk to them about and I let them know is there's 4 things we're going to discuss and get figured out for you. Number 1 is what loan programs are best suited for you. Number 2 is how much you can qualify for. Number 3 is what your monthly payment's going to look like. And, so you're within a budget. And number 4 is, I forget number 4 now that I'm on. No, you're going to talk about those things. You're going to talk about how much you qualify for, what your monthly payment looks like, what loan programs are going to be available for you. And the 4th thing, now I remember, is how much money you're going to need. How much cash you're going to need. If you want to buy a home, anyone that wants to buy a home needs to know those 4 things. And we figure out based upon, what loan products are best suited for that person, which is really dictated by their situation. Everybody's different. Depends upon your credit, depends upon if you're a veteran or not, or where your credit scores are at, and how much money you have and what your budget is. And then we work up numbers to determine this is what it looks like for you based upon your situation. And that's a 10 to 15 minute process. And then what, everyone always hears about, it's got to go through underwriting, and that sounds really scary to a lot of people. And it's not scary at all. The underwriter validates the information that we input on someone's loan application and verifies it, makes sure that it meets all the standards and can be verified, because you can say someone makes $20,000 a month, but if you don't have the documentation to back that up, and that's what an underwriter does, is verifies everything, that's all documented properly so that the loan is saleable, so that the loan is a good loan and the loan can be granted to the buyer.
And when you're working with Adam and I, we're here with you with Ryan throughout the whole process as your quarterbacks, guiding you through working with Ryan, working with our appraisers, working with the inspection, working with Sarah. So you're not overwhelmed, and we take it step by step. But something that go ahead.
No, I was just saying it's about helping you navigate by taking the emotion out of it. Buying a home is a big deal. It can be confusing at a lot of stages. It can be scary. It's a big commitment, right? So it's a very emotional process. Understand, I get it. We're here to not only take that emotional side out of it for you, but kind of have your back and make sure that all the things are being done along the way. And then letting you kind of see the light on the other side of how nice this home is for you and your family and your future. But, trying to do all the heavy lifting on the back end so that you're not consumed with all this stuff. Now, Ryan, quick question for you, because I'm sure you get people call you up all the time, whether it's a referral or they find your number. You went through a great list there a moment ago of, what are the things that you look at? What's the information that they need? What would be, for somebody who's thinking about buying a home now, their first time, what would be a kind of a bullet point checklist that somebody needs to kind of lay in front of them and have ready to go so that when they do contact you, they have all the stuff they need? We get calls all the time. People want to get in the car. They want to drive around. They want to go look at houses. And it's like, well, that's like step 10 before, there's 9 more things that need to happen before you're ready to start going to look at houses. What are some of those things that you like that make your job easier when people show up at your office for the first time that they have in hand?
Well, anytime we talk to someone, we look at credit, we look at their income, we look at their assets. And what validates those is your documentation that you need as a buyer to provide to the lender. And it's the same for every single buyer. And it's a really easy list of items. You need 2 months of asset documentation. So 2 months of bank statements, brokerage statements, crypto statements. By the way, Bitcoin's at a new high for, in a long time. People have money in crypto. It's new times, right? So you need 2 months of asset documentation. You need 2 years of income documentation. That doesn't mean you need 2 years of pay stubs. You need W-2s for 2 years. So right now, today in 2024, we need to see your 2022 and 2023 W-2s. Typically, tax returns are not required. There are a few exceptions when you do need tax returns. You'll need those if you own investment properties to show the rent that's been received on those. You'll need tax returns if you're self-employed and you're not a wage earner. You don't work for somebody else or have W-2s. That's when you need tax returns. Typically, most borrowers that are wage earners, that work for somebody else, that are employees, that have taxes taken out of their paychecks, it's just W-2s for 2 years. And then you need 30 days of pay stubs to document your, what you're making and show that you're currently working at that employer and what your rate of pay is. And that's typically the documentation that is required. 2 years of W-2s, 30 days of tax returns, and 2 months of bank statements. It's a really simple list. And so when we do an application, we ask people about those questions, and then we let them know, hey, this is the documentation we're going to need based upon your situation. We personalize that. If they're self-employed, we're going to ask for those tax returns. If they're not, we're going to ask for those W-2s. But it's very simple items. Most people, it takes them 5 minutes to, collect the documents that are needed. And we need a government-issued ID. So driver's license, passport, super simple things to document and get a mortgage.
So that's when they meet you. That's great. Thanks for that advice. I didn't realize it was just so simple. I mean, how easy is that, right? Like you said, 5 minutes. What about some folks that are maybe, younger, it's their first venture down this road, and they have some things that, maybe they're looking at. Would you recommend they pay off their credit cards? Do they, what are some things that they can do, pull their credit and maybe dispute some things on there, work with a credit repair company if they've maybe had issues in the past? What are some things they can do on that level prior to meeting with you?
It's typically more important for someone not to pay off their credit cards and have their money in the bank so that they have it available for their down payment or closing costs. But there are some exceptions when it's more important to use some of that money and allocate that to pay down your debt. One of the instances that I would give someone advice on to pay down their credit cards is if you need to increase your credit score. If you need to increase your credit score, and one of the reasons that your credit score is low is not because you don't pay your bills on time and you have lates, it's because you owe money on your credit cards and they're close to being maxed out or have higher balances. Paying down those cards will raise your credit score, which will give you a better interest rate. My job is to look at everything and give someone the best advice based upon the income they have, or not income, but assets that they have and money in the bank and what to do with that and where to allocate it to accomplish the mission. So there isn't a one size or one shoe fits all situation on what that looks and feels like. It really is situational and depends. But it's working with someone that understands the business, has closed a lot of transactions, and going to give you that best advice on what to do with your money, on what you need to do. And the other reason someone would want to pay things off or pay things down is if they need to have lower monthly obligations in order to qualify for a higher amount. So there's a lot of things that need to be looked at on everyone's given situation. The great thing is it's super simple to do. It doesn't take long, 10 to 15 minutes, and you're able to develop a customized plan for a buyer and someone looking to get into a home so they know exactly what they need to do.
Something that I want to share is when I grew up, I had, came from, hardworking family, and it's really nice that homeownership brings wealth. And as Sarah was saying, who's one of the smartest ladies I know, and one of the people always see it's like they're thinking they want to put 20% down. They want to put 20% down. But I've and Ryan, if you can, maybe share a tip on this. Is home buying tip better to maybe put less money down and then maybe take that extra money that you maybe put 5% down or 3% down and then take the extra percentage of that money, pay a lump sum to your principal, and then you can recalculate the mortgage so they owe less money and they can have a lower payment, something like that?
People do that oftentimes when they have a big sum of money that's coming in after they close. It's not something people will typically do beforehand, but if someone's selling a property and going to have a couple $100,000 and wants to have a lower mortgage payment, they can recast their loan, meaning they take those funds, send them in, and now their mortgage payment is based upon a lot smaller principal balance versus where it's at. And a lot of people that are retired that have a home, they want to sell it, they want to buy another home, they don't have it sold yet, but they qualify with both mortgage payments, will oftentimes recast and do that. If someone just has a large sum of money, it's always best to be prepared and do things right the first time and game plan. Should they do a loan and put down 10%, 20%? And again, everyone's situation is going to be a little bit different. My advice from what I've seen over the years, you're probably better off putting down less money than putting more if you have a bunch of money right now where you could put down more. Because what people don't realize, especially first-time home buyers, when you buy a home, there's always expenses when you buy that home that you're going to want to do to personalize that home. If it's a new construction home, you're going to have to put in a yard, and if you have an HOA, they're not going to let you have dirt there, nor do you want just a dirt yard for very long because it gets dirty and dusty, and it costs money to do that. And I've seen people over the years take a lot of money, put it down, and then they want to refinance and pull out money because they're like, man, I really shouldn't have put that much down. Now I have a bunch of debt because I had to finance and take out loans to do my yard and my shutters, and I replaced this in the house and replaced that. So it's really just prepping people, letting them see all the angles and trying to give them the best advice based upon their situation so they do it right the first time.
Right. A lot of buyers are thinking, well, I shouldn't buy a home right now because interest rates are high. But if you're thinking in a lot of people's mindset that they want to put 20% down. So if you're buying a house for $500,000, if you put 20% down, but instead put 10% down or 3% down, take the remainder of the money and then pay the mortgage off and recapped it, your payments would go down and you would owe less money. That's kind of where I was getting at. Is that
Agreed.
Something that could happen?
Yeah, definitely, for sure.
So, anyways, anything new with supply and demand and the housing market here, Sarah?
Well, what's exciting right now is that we do have a lot of people coming here and we have a lot of job growth. And the things that make for a healthy housing market are jobs and migration. So we have those two things. Right now where we are, we're seeing both supply and demand are increasing. They're kind of increasing together right now. We saw, especially after the last few years, we've had very, very low inventory. We've not had a ton of new listings hitting the market, and that has kept our prices going up. I mean, you even see Kate Schiller just came out recently, and that is still showing an increase, even though it's 3-4 months late. It's a very old report, the way it's released. However, it's representing and reflecting the positive annual price growth. And so we're seeing that. We're seeing it continue. In 2023, we probably had a 5-6% increase. 2024 is projected to probably be around there again. So prices are still going up, and because there's the demand and there's not a ton of listings, and that's always going to put pressure on prices. So regardless of what happens with mortgage rates, we know that house prices are going up. And so in these conversations, when you're talking about the down payment amounts, when you're talking about what you're up against, when you're talking about, hey, what's the difference with, moving into a rental or moving into, a home that is purchased, you got to take all these different pieces into consideration. And I would say the biggest one is the fact that prices are going up. This is not a high velocity market, but it is enough where we have demand that's buying up the houses. And with that, anybody who's sitting on the fence, if we continue to see these prices increase, it's only going to put more pressure on affordability rather than kind of going in and having these conversations now. So what I would recommend anybody who's thinking about buying, absolutely explore all of these options. Have those conversations with Holly and Adam and Ryan about what is the best place to be. How much money do I put down? Because there are so many different aspects and things that they can do to make it very beneficial to buy a house right now.
Absolutely.
And the fact that home prices are staying stable and in a lot of cases, continuing to go up. Interest rates have nowhere to go but down, I think, at this point, right? I mean, who knows? They can always go up. So you have the possibility of, kind of double dipping, right? Your payment can get cut, in a year or so when the rates start to come down, below where they are now. You have that refinance option as well as building equity over time. And so, any time is a good time to buy a home. Don't, have the negativity of, well, it's, interest rates are high. It's not permanent. Interest rates move daily. And so, just get into something, because every day you don't buy a home is another day of equity you're not putting in your pocket for the future.
I just got to tell this story is, there's always different times in which you buy a house. I bought my house in 2000, my first house in 2009. It was not the most ideal time to buy a house.
Right.
Prices were declining quickly. However, you know what? I had a roof over my head and I lived there for 5 years, and we made $35,000 when we sold it. And I felt like I won the lottery. Like, it was amazing. I bought my next house. I mean, the cycle worked even when it was, because you can't truly time a market. You just can time what is best for you in your certain circumstances.
Right.
Yep.
Well,
Thank you.
I want to thank everybody for coming, and I hope you guys gained some good information about buying a home, and it's always a good time.
Yeah.
And thanks so much, and bye for now. We'll see you next week.
Thank you.
Thank you.